This is a simple moving average. Here comes one of the oldest, most popular tools used by day traders daily. In this video, we'll tell you all about the simple moving average, including how it's calculated and displayed, how to set it up on your charts, and most importantly, how you can use it in your trading. So what is the simple moving average? The definition is a technical indicator that calculates the average price of a financial asset over a specified period of time. To calculate that, we simply add up the closing prices of an asset over the specified period and divide by the number of periods selected. For example, to calculate a 50-day SMA, you would add up all the closing prices of the asset over the past 50 days and divide by 50.
Simple moving averages, or SMAs, are commonly used in trading to help identify trends in the market. So when the price of an asset is above the simple moving average, it is considered to be in an uptrend. And when the price is below the SMA, it is considered to be in a downtrend. Traders also use SMAs to identify potential buying and selling opportunities. If the price of an asset crosses above its SMA, it could be a signal to buy the asset, as it may indicate that the price is likely to continue rising. If the price crosses beneath the SMA, it could be a signal to sell the asset, as it could indicate that the price is likely to continue falling. The simple moving average is known to lag and react slower to recent price action and movements as the period becomes longer. This can be a bit of a disadvantage, as it may not respond quickly enough to sudden price changes that could be significant.
All right, thank you so much, Neil. Now let's see it live in action. What I have here is Google. Now I chart on here, this pink line is the 50-period SMA. So what we're looking for here is a nice little rebound off the SMA and using this as support. I want you to understand a few things here. This is a 200-period moving average. This is a 1-minute chart. So what we're actually looking for is some kind of a consolidation with not only the candles, but also matching with our SMAs. So the 200-period right here, respected down at 92. So not only is it a $92, but it's also the level of the SMA. So when we're going long here at 92.50, we have protection of volume weighted average price, which is the blue, but we also have a longer trend validation here back up to the upside. So as we go, we first take a break of the SMA back into the long. So here we go, riding this to the upside. As we see it breaking higher, we take this long. Hit, back, reject. There it is again. We take the long. It comes back in right there. Now, this is where you could have reloaded when it came back into your SMA, the 50 period. Instead, we were waiting for this 200 to get a little bit of a better price. But then, once it comes in, tests the SMA again, then takes out new high, that's where we punch long one more time. So back into here, into recent highs of 93, comes back, tests the SMA, and then the break higher, and now we're cruising to the long side. So once you get in the second time off of a rejection there of the SMA back up, that gives you the go-ahead, taking out past highs and now blasting it to the north side. So this is a pretty simple trade that you as a trader can look for in many different names. I like this trade. I use the 50-period SMA daily. Every single time I get a chance to, we're using this to judge trend.